To our Kansas Alumni Association Homebuyer Workshop. My name is Jason Maida. I'm going to be your host this evening. Really excited to be able to share this content with you. I appreciate you taking time out of your busy schedules to join us on a Wednesday evening. But we promise to bring you some really great content to help you on this journey towards homeownership. I know we're in the middle of March Madness, so a lot of exciting things. Tournament starts tomorrow, so I know for our KU alum, there's probably other things we have that we're looking forward to tomorrow outside of home ownership. But I promise to give you a really action-packed hour-long content tonight. Tonight's a very interactive session, so we encourage questions as we go through tonight's content. So what we'll do is we'll roll through our slideshow, have some interactions with questions that come into from our audience. You can use the Q&A function within Zoom, or we'll also monitor the chat feature, and we can kind of pick up your questions from there. This is a class that we present every quarter to the KU alumni, and really excited to be able to bring this to you. This is our second installment of the classes scheduled for 2025. You'll learn a little bit more about other dates we have forthcoming for our partnership with the KU alum. A little bit about our organization. I work for an organization called American Pacific Mortgage. We're the 10th largest lender in the country, and our team here presents content like this all across the country through our different alumni associations. We're super proud of what we're doing with the KU alum. We've actually got to successfully help some of your fellow alum navigate the home buying waters and get the keys to their home. In fact, you might have been seeing some of the quotes from some of our clients that have purchased homes and their experiences with us. So we hope that after you enjoy tonight's presentation, that you'll be able to start those steps on your way towards home ownership. And so as we look at tonight's class, we're going to spend some time looking at the housing market, kind of what's going on with the housing market. Also want to kind of spend some time looking at interest rates. Today, the Federal Reserve kind of made some announcements on what's going on from a monetary policy perspective. So I want to kind of share with you a little bit more about that. We'll also do a rent versus buying calculator, where we're essentially going to take a look at what does it look like if I continue to rent right now, but how does that compare if I decide to start those next steps in home ownership, and comparing essentially budgets between the two kind of lanes, if you will, in terms of housing expense. We'll also talk a little bit about credit, going to give you some resources around credit, how to potentially improve your credit score as you prepare for home ownership. I then want to talk about loan programs that you might have heard about before, and have really maybe questions around, and understand how those resources can support you with home ownership. Then we'll also talk about saving for home ownership, because that tends to be a big challenge for future home buyers, is how do I save up enough money to get ready to purchase a home? So we're going to help first identify how much should I typically need to save for home ownership, and then what's some plans that I can put in place to start a savings plan, action plan, if you will. We'll talk a little bit about first-time homebuyer programs that are available in different states across the country. Also go through the buying process. So after tonight's class, you may say, hey, I really want to learn more about how I can develop my own home buying plan to be able to pursue home ownership. We'll talk about what are the 6 steps that you're going to go through in basically pursuing home ownership. And we'll also talk a little bit about, booking a consultation with us after we've gone through tonight's class. All right. So that's our plan for tonight's class. Again, we encourage you to ask questions as we roll through tonight's content. I do want to make a note that tonight's class is being recorded. So we'll have this up on our YouTube channel tomorrow. So we'll send out the link to the YouTube channel, also pass it along actually in one of our last slides tonight. And we also will send over the entire slideshow. So all of our guests that have registered for tonight's class will get a copy of the presentation, and of course the link to the recorded version as well. All right, well, let's go ahead and dive in. And let's first of all talk a little bit about, does buying make sense for me? Because, for us considering home ownership, it's probably going to be the largest investment or just financial decisions that we're going to make whenever that time comes. Whether it's a decision we make in 2025 or in the next couple of years, it's going to be a big deal. And so obviously, because you're taking time out of your busy schedules on a Wednesday night to learn about home ownership, you understand the significance of that decision. And at the same time, when we think about home ownership and consider that, there's a lot of great benefits that come along with it, like being able to control and maybe have a little bit more stability in my housing expense than what I experience today as a renter. So I'm not worrying about my landlord increasing rents on me. Even though we're considering maybe purchasing in today's market where rates are a little bit more elevated, than historical averages, there still is an opportunity to potentially refinance a home down the road when rates start to normalize a little bit more. This is an asset, right? That asset should grow over time. So it's really a growth opportunity in wealth for you. This is probably going to be one of the biggest assets that you have in your portfolio, essentially. And as that asset grows, the value goes up, it appreciates over time. The difference between the value of my home, the difference in what I owe on that home is called home equity, which for most of us across the country is that number one asset. And there can still be some really great tax benefits that come along with owning a home, like the potential deductibility of interest on a mortgage. And there's benefits also from a tax perspective on energy efficient upgrades that I make to my home as well. So when we think about home ownership, I would say it's not really an apples to apples comparison, because essentially the things that we can realize as a homeowner don't obviously come about when we're renters. So we do want to factor that into our calculus when it comes to owning a home. And to help us kind of put that in perspective, we always like to start our classes by looking at a rent versus buying calculator. So we can kind of frame up, like, what's this going to look like? What's the comparison of home ownership going to look like for me versus maybe continuing down the lane of renting, which I'm currently doing today? Now, I think at the same time, affordability is a challenge for most of us all across the country, no matter where we're living, whether we're in Kansas, Missouri, Texas, Florida, California, you name it. Affordability can still be a challenge for us. And so, when we think about home ownership, there probably is going to be an increase in outgoing expense when we consider home ownership. But to reflect back on that benefits page that I just shared with you on home ownership, when we factor those into the calculus, there should be a really great opportunity when it comes to owning a home. And let's talk about what that might look like, right? So you're now looking at a page that is essentially our calculation of home ownership comparison to renting. And you're going to have this calculator to do your own analysis whenever you have some time. But ultimately, when we look at this calculation, it first of all takes into consideration my rental situation. So we're going to kind of run like a hypothetical situation for tonight, which if we had someone that's paying rent of, let's say, $1,700 a month, they would have also in their expenses a $15 rent expense. And then we're going to make the assumption that rent will go up 3% on an annualized basis. All right. So that's kind of where we're at in the rental lane. Now, if we look at the home purchase side, so we're going to make an assumption that we're going to buy a $300,000 home, that our rent will increase. I'm sorry, let me back up. That our home mortgage down payment will be 3% of the sales price, which you're going to learn a little bit more about programs tonight. But essentially, that's the minimum down payment for purchasing a home under a conventional 30-year fixed mortgage. And then you have estimated property taxes for your home. You have homeowners insurance. And then we have the maintenance costs of those homes. So basically the upkeep of my home. And then if we go into our loan information tab, our loan information houses like what's the term of my loan. So the 30-year fix is what we have here. Estimated interest rate at 6.5% today. We'll talk more about interest rates in just a few minutes. And then the origination cost of my loan. So when I take out financing, whether it's through our APM team or any other lender, they are going to have costs associated with their financing options. Now, one of the great benefits we have with our KU Alumni Association is we actually discount our services when you choose to work with us for your financing. So we actually discount our services by $750, which can be a significant discount for our clients choosing to buy. And that also carries forward for someone looking to refinance with our team as well. So whether you're purchasing or refinancing, there's the KU alum discount as well too. And then we have discount points, which essentially allows someone to pay additional funds out of pocket to bring down the interest rate that they're selecting for their home financing. At this time in the market, I don't necessarily recommend doing discount points because essentially those are investments of cash out of pocket for your home purchase that will bring down my interest rate. But the break-even point on those investments are usually 3 to 4 years. So if I put 1 point out of pocket, which would be 1% of my loan amount, let's say I'm financing $300,000. Well, that's $3,000 out of pocket, but that's only probably going to bring down my rate about 0.25%. So in order for me to break even on those investments, I would have to retain that loan for 3 to 4 years. But in all reality, most of our clients buying today are probably going to consider refinancing in a couple of years. So we just can't make those investments kind of work, if you will, when it comes to discount points. So not necessarily recommend, certainly an option for our buyers. buyers. And then there's other settlement services, attorney's fees, title and escrow fees, depending on where you're joining us and where you're deciding to buy within the country. Those closing costs or other settlement services might look a little bit different. These items like settlement services, origination charges, they all fall under the umbrella of what we call as closing costs and prepaid items for your home purchase. We always recommend clients to budget for those expenses about 2 to 3% of their purchase price. So if I'm buying a $300,000 house, I'm probably going to have to prepare for $6,000 to $9,000 in expenses. And then finally, the last tab is other assumptions. Here we're looking at what's the appreciation rate of my home? How long am I going to be in the home? When I eventually sell that home in 7 years, in our hypothetical here, what's it going to cost me to employ a realtor and pay for closing costs? What do my state and federal tax rates look like for the sale of that home? And then savings rates, if I was to kind of hold on to my cash, right? So ultimately, when we do the cross comparison of this and say, okay, I'm paying $1,700 a month in rent. If I decide to pursue home ownership, I'm probably going to have to step up my budget, right? It's going to go to about $2,500 a month. So we're factoring about an $800 increase in expenses. But if I was to do a total cost opportunity over 7 years, it benefits me $64,412 by owning that home over the next 7 years versus considering continuing to rent and not reap all the benefits of home ownership. So I would encourage our class, when you think about home ownership and decide on a budget, it's not going to be a fair comparison to say, hey, I'm paying $1,700 in rent, I should be owning it $1,700, because when I factor in tax deductibility, potential equity appreciation in my home, I might not only have more buying power, but at the same time, it's probably going to make it more tolerable when it comes to owning a home, because now we factored in all those upside benefits that come along with home ownership. All right. Now, I would encourage you to try to run that calculation when you get our presentation material tomorrow, because I think it'll be very enlightening to understanding a little bit more about what that looks like for you. Now, one of the considerations that homeowners and prospective homeowners have to take into consideration is what's the housing market looking like right now, right? And right now, we're going to start moving into the spring months where things are starting to warm up in most parts of the country. And so that also brings out buyer activity, right? And so usually when we're in our late fall, winter months, the housing market kind of slows down. You can see that represented by our graph here. And we're looking simply at the Kansas market right now. If you're joining us from another state, certainly these numbers are going to look a little bit different, but trends don't necessarily look too much different. Price points, of course, change. So we're seeing, a little bit of a downtrend here, but then we're kind of lifting up here. We're seeing some upward mobility in prices of homes. A lot of that is derived from lack of inventory. And so as we move into the spring and summer buying months, which historically are your busier months, then we'll see more buyer activity pick up. But what's going to be unique in this market this year is like, what's the inventory look like? Is there enough supply to support the demand of buyers? Because if there isn't, we'll probably see prices rise. And you can see, a little bit of an uptick right now in the Kansas housing market right now. So, interest rates will fuel a lot of that buyer activity out there in the marketplace. And so ultimately, that will fuel buyer demand. But if we don't have enough supply to support that demand, then we start to see prices inch up. And the last thing I wanted to point out here was just kind of how long homes are staying on the market. 43 days, pretty average for most parts of the country. 43 days on market essentially is from date it goes on market to date we get an actually offer executed. So that's what that metric looks like. Again, as we move through into the spring and summer buying months, where some families are trying to figure out what school district they want to move to, or maybe there's a relocation of employment, whatever the case may be, we start to see those activity levels start to tick up. Now, I mentioned earlier, interest rates are going to also influence buyer activity. Today, we had the Federal Reserve come out with a monetary policy update because they were on Capitol Hill for the last 2 years last 2 days with just kind of deliberating on what's going on with the economy. Are we seeing some positive momentum and improvement in inflation numbers? What's our labor numbers look like in employment across the country? So the commentary that came out from Jerome Powell, the head of the Federal Reserve, was encouraging from an interest rate perspective. And so We'll be on the lookout for a potential rate cut of the federal funds rate, hopefully down the road, but it actually improved interest rates based upon the commentary that came out today. We are seeing inflation start to cool a little bit. Obviously, we still feel the impact of the cost of goods and fuel and housing. So inflation still remains high, I think, as we experience it as a consumer. But the inflationary goals from the Federal Reserve is 2%. I still think we're running like around 2.6, maybe even 2.8. But the goal is to get to 2%. So we will probably see, interest rates get cut at some point from the Federal Reserve. Now, when the Federal Reserve cuts rates, the federal funds rate, it doesn't necessarily directly impact mortgage rates, but it will impact credit card rates, lines of credit, personal loans, things of that nature, but it does have a ripple effect into mortgage interest rates. And when we look at interest rates over the last 20 years, you compare that to where we're at today, it doesn't look too bad, right? Interest rates go through this cycle of waves based upon what's happening economically. So this chart that you're looking at here, this gray bar here represents the housing crisis of 2008, where interest rates still remain at elevated levels, but obviously, our housing market was, really destroyed at that point in time. But, when we look at rates start to, go lower as we move through to 2010, and then we get to our pandemic, which is represented by this level, rates, of course, did touch down at 2.5%. One of the questions I get from clients as they're considering home buying options is, should I wait for the 2.5% interest rate, right? That was a very unique circumstance where we had a global crisis of the pandemic. And so that's why rates reached those unprecedented levels. It's highly unlikely that we'll ever return to those. And frankly, we don't really want to, right? And so I think, when you think about normalized levels of interest rate, we're probably in the 5.5% level or slightly lower, maybe even low as 5% to 4.75. It will take some time for us to get there. I still think we're probably a year or 2 years away from those level of interest rates. You can see here the last 12 months of interest rates. Right now, we're on a nice little move, but we're not as low as we were back in September when we all thought things were going to change for the better. And then we saw this, uptick again in interest rates. So I think we're on the downside of things from an interest rate perspective. I think as us in class considering homeownership, we're going to have to give consideration to our timing of buying, because ultimately, the longer I wait, probably interest rates are going to go down lower, right? But the trade-off to that is inventory levels have to change, because ultimately if buyer demand increases, I don't have more supply out there, we'll probably see interest rates rise sales prices rise. So I think that's the thing that we're going to have to consider as prospective buyers. Now, interest rates aren't all the same for all clients. Credit score and eligibility of product takes shape in the interest rate offering. The type of program that we're going to elect, how much I decide to finance, what my down payment percentage looks like. The lesser my down payment is, potentially the higher my interest rate could be. We talked a little bit earlier about discount points, so that's kind of what you're seeing here in this bullet point. And then the loan term can change the complexion of the interest rate. So generally, the shorter my term is for my loan, the lower my potential interest rate can be. Ultimately, when we connect with our clients for their home buyer consultation, we're going to figure out the right design work of their financing, whether the type of program, the term of my loan, the down payment, and the overall interest rates. But I think it's important to understand interest rates do change by the minute based upon market activity. So the commentary I gave you on federal Jerome Powell talking a little bit about the state of the economy and monetary policy. Well, that moved interest rates to the positive after 11 o'clock Pacific time, but at 8 o'clock Pacific time, interest rates were flat to a little bit low. So those things can change really quickly. All right. Now, credit is one of the characteristics that go into interest rates. And so one of the things we like to do in our classes is just kind of dive into credit and just give a little bit more visibility to how we see credit and try to give you some tips and resources to help you as you prepare for home ownership. I do think it's important to understand that every loan program has a minimum credit score requirement. So you can see some of the kind of the core programs listed here. So the FHA loan has a minimum credit score of 580. Conventional loan minimum score of 620, our VA home loan for our veterans that have eligibility is 620. And then some of us might consider buying in rural areas. There's the USDA product with a minimum credit score of 620. So we're going to dive into the modeling of credit or the weighting of credit scoring. I know many of you in today's class have visibility to what your score looks like because you're maybe using tools like Credit Karma, maybe some of the credit agency tools offered through TransUnion, Experian, and Equifax. All that is great. I think it's just important to understand as a consumer that there's really three different models to credit scoring. There's the credit card model, which, by the way, is used for most monitoring systems. There's the auto financing. So if I'm going to go buy a car, and then, of course, the mortgage model. So for home financing. So, of course, the home financing model is what we're going to take a look at today. So major events like short sales or collections or bankruptcies, those are going to have a longer lasting effect on your credit score. But most credit items are going to have an impact on your score for the most recent 2 years from the date of the event. We're going to talk a little bit about credit utilization as it relates to revolving accounts here in just a bit. Account closure, I want to spend some time looking at that as well. So that's essentially when you close out a revolving line of credit, what that does potentially to your credit score. Now, there's 3 credit agencies involved in scoring. There's TransUnion, Experian, and Equifax. In lending, we look at all 3 scores, but we take the middle score when it comes to qualifying for interest rate, home program, and then, of course, mortgage insurance. Now, if I'm a client that, let's say, has a 760 as my highest score, 740 is my middle score, 720 is my lowest score, from a financing perspective, we're going to use the 740 credit score when it comes to qualifying. Now, that's if I decide to apply by myself, right? Now, if I have my partner that's also going to join my application because they contribute income to the household, but let's say their scores are slightly lower. They're at 700, 680 is their middle score, and then 660 is their lowest score. Well, 680 is a score that we're going to be using from a qualifying perspective. So that's really important to understand because we want to be very strategic when we do our home buying consultations with our clients, because we want to see that maybe it makes sense to apply in just one name or maybe both names, depending on where you're at financially, because ultimately we want to kind of design the lowest cost and optimal financing plan to help you achieve homeownership. Now, if you've had some past challenges on your credit, maybe a late payment, maybe you've done some recent hard inquiries on your credit, here's a matrix that'll kind of show you how long those things will stay with you on your credit file. Okay, so you can check those out here. I want to spend some time looking at the mortgage model for credit scoring, and so to give you some perspective and really how to kind of get your credit in the best possible health when it comes to preparing for home ownership. So let's kind of just walk through this this model here. So the weighting of this is as such is that 15% is going to be how long I've had credit. So the more mature my credit file is, the higher my credit score could potentially be. So if I have a 10-year credit history versus maybe a 2-year credit history, my credit score is going to see the effects of that. In-use credit is going to be how long or how many credit accounts have I opened recently. So if I open 2 accounts in the last 6 months versus 2 accounts over the last 2 years, it's going to change what my credit score might look like. Also, am I trying to apply for new credit? Well, that would be around hard inquiries. So hard inquiry is when a lender gets visibility to your credit score by accessing your credit file. Now, one of the things we do in our process is we always start with a soft inquiry, and that's a different approach than what a hard inquiry does, because the soft inquiry only gives us visibility to your scoring and your payment history, but does not put the impact in your credit score. So, as we prepare our clients for home ownership and pre-approve them for their home buying experience, we don't want to impact that credit score negatively. So we always start with that soft inquiry first. So that's kind of 20% of the weighting is new credit inquiries and new accounts opened. And then we have this next section here, which is probably the biggest area of opportunity for most prospective buyers. That's around credit utilization. Essentially, what do my credit balances look like versus my credit limits? And that's 30% of the weighting. So if I have, let's say, $5,000 in balances and a $10,000 credit limit, I'm essentially at 50% credit utilization. Now, the optimal level of credit utilization is 10%. So I really want to drive that balance down to, let's say, $1,000 in that example. And so that's kind of what we're targeting. Now, if I just booked a nice trip to, Disneyland, and now my credit card's at 90% utilization, well, my credit score is probably feeling the effects of that. So as we're preparing for home ownership, I would tell our client, let's try to get that balance paid down a little bit so we can improve the utilization and therefore kind of lifting the credit score. Now, the credit card companies will send out data to the credit agencies every 30 days. Now, that data is released on your billing cycle date. And so one of my tips that I would give our class tonight is that if you can try to pay down those credit card balances before the billing cycle date, um, or pay them off entirely, because that's going to give you a lower balance, therefore increasing your availability and lowering utilization, which lifts that credit score. And of course, we're looking to try to optimize that credit score. So the tip there would be try to pay down or pay off the credit card bill before the end of the billing cycle date. And then the last weighting is payment history. So that's essentially, how am I paying my bills? If we do have late payments, they're rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. Of course, the more severe the delinquency, bigger impact I'm going to have to my credit score. Now, if I've had some past challenges on my credit, I mentioned this earlier, the kind of the impact period is in the most recent 2 years from, I'd say 12 to 24 months from the date of the event. All right. So that's kind of how we'd see that. As I get further away from that date of the late payment or maybe that hard inquiry, I should start to see organic improvement in my credit score. Here's an example. I was meeting with a client earlier today, and they have a charge off on their credit, which essentially means the creditor took the account as a loss, but the client has paid off the balance since then. Well, that event occurred in October of 23. Once they reach October or November of 25, now we have 2 years elapsed. So when I model out that client's credit, we actually see the credit score lifting up pretty significantly because now they're outside of that 2-year window. Okay, so that's kind of how we look at events on credit scenarios. Before we jump into student loans, I just want to see if our audience, do we have any questions so far from our group? And again, you can use the chat feature or the Q&A, and I'll grab those questions there for you. Okay. So I do want to spend some time talking really briefly about student loans, because if you do have federal student loan debt, more than likely it's on pause or in forbearance because of the pending litigation regarding student loan forgiveness. From what I've heard, we're not going to have any outcome of that until September or October if we're lucky. The reason why I point that out to our class tonight is because in qualifying for financing, if I do have student loan debt, we do have to identify and qualify our clients with that student loan debt, even if we're in forbearance or possibly we're in deferment because let's say we're back in school, whatever the case may be. So I just want to help you kind of understand the calculation. So if we elect, let's say, an FHA loan, the Federal Housing Administration loan, we have to select a 0.5% factor when calculating your student loans. So if I have $75,000 in student loan debt, then I would use a $375 payment to qualify the client. Now, if I'm electing a conventional loan, so that'd be like a Fannie Mae loan, if I have the same $75,000 in debt, then we would use 1% or $750 as the monthly payment. So that's really important for our clients to understand because it can change buying power. And we'll certainly go through that when we meet with a consultation with a client. Now, if you're in active repayment and you already have the save plan hooked up on your student loan, or you're in an income-based repayment program, if I have the same $75,000 in student loan debt, and let's say that payment's $250, well, as a lender, we can use that right away. Okay, so that's just something I like to share with our classes, because as we teach with different alumni associations across the country, inevitably student loans come up. So I think it's just important to understand kind of our approach from a lending perspective. Now, the reason why we look at those student loans is because when we set up financing for clients and select a particular loan program, each loan program has guidelines that we have to apply to, and those guidelines will also address student loans. So let's spend some time looking at overall kind of loan programs that are offered to you as prospective buyers. And I like to kind of spotlight 5 of the core programs just to give you a sense of what your options look like. Now, ultimately, when we meet with our clients to figure out their home buying plan, we're going to kind of dive into one specific product based upon eligibility and qualifying and figure out really what's the right fit for our clients. So let's talk about the first one, which is the conventional loan product. That is a Fannie Mae and Freddie Mac loan. You may have heard of that terminology, especially during the housing crisis. Fannie Mae and Freddie Mac is kind of a quasi-government agency, but it houses the conventional loan product. It's about 60 to 70% of all originations across the country go through the Fannie Mae or Freddie Mac channels. Minimum down payment is 3% on that program. Minimum credit score of 620 with a maximum loan amount of 806,500. That's called the conforming loan limit. That loan limit changes every year based upon cost of living adjustments by the finance agencies. And so we'll probably see that go up again next year in 2026. We usually get the results of that sometime around September, October. Next loan is an FHA loan. That's the Federal Housing Administration loan. That's a government insured loan. Minimum down payment of 3.5%, slightly lower credit score minimums at 580. The limits for FHA will vary by county of where you're deciding to purchase. So for most counties in the greater Kansas market, it's 524, 225, but it can change depending on what county you're going to look at. Now, we're going to do a comparison of mortgage insurance for conventional loans and FHA loans in our next slide. So we'll kind of size up what does it look like differently in terms of mortgage insurance. And I'll kind of explain to you a little bit more about what that entails. The next loan is a jumbo loan. That's for clients that need a little bit more buying power that stretches beyond, let's say, the Fannie Mae and Freddie Mac conforming loan limits. Has a minimum down payment of 10 to 15% down, usually higher credit score requirements of 700 plus. It's not going to be typical for our first-time buyers to have an entry point in a jumbo loan, but it certainly is a resource available to our buyers. The VA home loan is for our veterans that have the VA home loan eligibility. There's a zero down payment option for that product, minimum credit score of 620. And the VA product's going to have a lot more flexibility as opposed to other products just to encourage home ownership for our veterans. Those veterans that have any type of partial disability have an potential exemption from what we call a VA funding fee, which can save them anywhere between 2 to 3% of their total loan amount. And then the USDA home loan is for clients that are looking to purchase in more rural areas. The USDA product has two qualifiers to it. Because it is a zero down payment option, the qualifiers include looking at household income for the area that you're going to buy. And then the area also has to qualify as kind of a lesser populated USDA qualifying area. Most parts of Kansas, that maximum loan amount is going to be $398,600 for the USDA product. Okay. So that gives you kind of a sense of what different products look like. Now, I want to kind of dive a little bit deeper into PMI. PMI stands for private mortgage insurance. There's both private mortgage insurance and then there's standard government mortgage insurance, which is part of a FHA loan. And so I think it's always helpful for our classes to explain what PMI is, first of all, and then how does it get calculated and where does it come into the loan buying process. And so when we look at PMI, first of all, it's insurance that essentially protects the lender against default by the buyer. So if we had some economic hardship, we couldn't pay our payments, that mortgage insurance would kick in to protect the lender. And on a conventional loan, mortgage insurance has different levels of cost based upon down payment, credit score, and then how much I decide to finance. You'd almost kind of look at it like car insurance, right? The more I commute in my drive time, the fancier my car is, but whatever my driving record looks like, that's all going to play a role in my cost of car insurance. Mortgage insurance is very similar. So the higher my down payment is, higher my credit score is, lesser my cost of mortgage insurance is going to be. Now, conventional mortgage insurance has a cancellation option that once I reach 2 years in my loan and I have 20 to 22% equity, I can apply to have my mortgage insurance essentially canceled. So that's a big benefit with the conventional loan. Now, if we were doing some home searching on, let's say, Redfin or Zillow, we've already started that. What you'll find is the calculators that are used on those sites tend to have very elevated or inflated mortgage insurance costs. So it can be a little bit discouraging as a buyer. But I'm here to tell you that if, depending on what you're deciding to purchase, at what level, what your down payment looks like, and your credit score, it's a lot more reasonable than you might think. In fact, if you were to look at like a $300,000 loan amount, you had a 740 credit score and you were putting 3% down, your mortgage insurance might be as low as $92 a month on a conventional loan. So a lot more reasonable than you might have seen in other online calculators. Now let's compare that to FHA loans. Now FHA loans have two mortgage insurance components. There's the monthly mortgage insurance, which is always 0.55% of my loan amount, regardless of my down payment, regardless of my credit score. So it's always going to be set at 0.55%. Now, there's also upfront mortgage insurance, which is 1.75% of my loan amount that gets added into my loan amount. The buyers can pay cash for it if they want to, but generally most clients will finance that cost. FHA loans do not allow a buyer to cancel the mortgage insurance. Only way on an FHA loan is if I decide to refinance out of an FHA loan into more of a conventional product. So if we looked at the calculator here, you can see on the FHA loan, same $300,000 loan amount, upfront mortgage insurance is $5,250, monthly mortgage insurance is $137 per month. Clearly a big difference between monthly costs. And then of course we have the upfront costs with FHA versus conventional. So I think the takeaway for our class tonight here is that to understand that FHA is another tool available to you in homeownership. It may not be the right fit because FHA ultimately has different guidelines than say the conventional loan, lower credit score requirements, a little more leniency, especially when it comes to past credit challenges. And so, as we meet with clients, we're going to figure out what the right design is for you in home ownership. And I think a big misconception is that, people feel like just because they're first-time buyers, every buyer has to use an FHA loan, which is a big misconception I hear all across the country, which really isn't the case because if we're qualified, ideally, I would love for a client to leverage the conventional loan because all the benefits that you've heard this evening, but certainly FHA is a great entry point into homeownership. We would just look at it more of a temporary solution to kind of bridge the gap for when we can hopefully refinance down the road into more of a conventional loan product. All right, now let's talk a little bit about qualifying income because as we consider homeownership and, we're trying to figure out, what's the right budget for myself. As a lender, I need to determine what the qualifying income looks like to make sure we have enough income to support ultimately the expenses that you're going to have or realize as a homeowner. And so there are documents that we're going to ask for in that qualifying process. You can see those on screen here. If I am self-employed, we're probably going to need a little bit more documentation, especially the last 2 years of filed tax returns. And when we look at qualifying income, we generally have to take a snapshot of the last 2 years of work history and or educational background. And the reason why I say that is because there is a little bit of a misconception in our industry that I have to be on my job 2 years to qualify for a mortgage, which just is not the case. I have to just demonstrate that I've either held employment for the last 2 years and or education in that same 2-year time period. So if I graduated from KU in the fall, I just started my job January 1. Because I have my 4-year educational background with KU and now I'm starting my new job January 1, I can potentially use my income, even though I've been only on the job for 3 months, to qualify right away for home financing. In fact, if I'm getting ready to switch jobs and I want to use my new prospective income for my qualifying, we can potentially do that with as little as an offer letter to consider that income for home ownership. Okay, so those are things that you may have heard differently in the marketplace, but certainly those are allowed in financing. Now, where it gets a little bit different from a 2-year rule perspective is that if I have dual employment, so sometimes we see this in the healthcare industry where maybe I have clients that are working for multiple facilities for a healthcare organization. If I'm working 30 hours at one, maybe 20 hours at another, in that case, I do have to demonstrate that I've been on both jobs simultaneously for 2 years in order to count that income. So that's where that 2-year requirement gets a little bit different. But if I'm going to start a base salary position, one job at $60,000 a year, and I'm just barely starting that job, that income can be used right away. Now, for self-employed, it is a 2-year requirement where I have to show 2 years of tax filings to be eligible to use that income to qualify on my mortgage. Last thing I want to touch on here is other sources of income. Like let's say I have a roommate that contributes to my household budget. More than likely that roommate's supplemental support is not going to be counted for qualifying. Some products will allow that, but most do not. If my partner elects not to be a part of the financing, then that income from my partner cannot be included into the qualifying unless they decide they want to be on the application and qualify for the financing. All right. So that's kind of a quick look at income. Obviously, clients have different scenarios that we talk through as part of a consultation, but that kind of gives you a general idea of what we look for on the lending side when it comes to qualifying income. Now, we also look at expenses versus income. We call that debt to income ratio. So we're taking into consideration in this calculation what my current expenses look like, credit card debt, personal loans, student loans, car loans, anything like that. But we also factor in what's the new housing expense going to look like for the home that I really want to purchase, right? So that housing expense includes the principal and interest of my loan, what my property taxes look like on the house, prospective homeowners insurance, if I'm putting less than 20% down, what that mortgage insurance looks like, right? So we're going to put that into the expense line along with the other debts like the car loan and the student loan, all that stuff, right? Now, we want to take that into consideration. So if we have a scenario where someone's paying, $500 in those expenses, $2,500 in a prospective new mortgage, now we know that's $3,000 a month that's going to be in my expense line. If I'm making $8,500, for example, then my debt to income ratio, so my expenses to income ratio is 35.3%. So the rule of thumb in lending is we can't have that number go above 45 to 50%. Keep in mind, we're using a pre-tax number, so it's a pretty aggressive calculation. But what I found in teaching hundreds and hundreds of classes to home buyers all across the country is that the comfort zone is usually 33 to 36%. Now, you may say, hey, Jason, I feel really good at 30%, and that's even lower than the comfort level. But I get asked often, like, where should that number be? And I think 33 to 36% is probably what I would consider an excellent level. As we get further in debt to income ratios, some of it's just a product of housing costs. Like if you're trying to buy in, an expensive part of Florida, or you're trying to buy in, Metro Dallas, Texas, and you're looking at a $700,000 single family residence price, well, that's going to be a bigger strain on your potential debt to income ratio than, let's say, a $400,000 price of a home in a different part of the country, right? So those are all things that we take into consideration. Ultimately, our goal here is when we look at debt to income ratio is to have a discussion around affordability, because that is one of the biggest pieces to home ownership is this situation affordable for me? And is this sustainable for me? So if things change economically for me, can I still afford my home? And that's one of the two really important goals for us as we design home buying goals for clients. Last thing I want to talk about before we move to the process, and then we'll be wrapped up before the top of the hour, is to talk a little bit about savings plans. And so savings can be one of the other challenges for home ownership. I think about it probably in this frame is like there's probably challenges around credit potentially because I'm overextended, but it could also just be because maybe I'm new in my career and I just don't have a lot of savings right now because I'm trying to get through student loan debt or whatever the case may be, right? So let's talk a little bit about what we need to do from a documentation perspective, and let's talk about a savings plan. So when it comes to documenting what we have saved so far, we're going to look at bank statements, for example, in the last 60 days. If you have cash deposits, those can't be used. But we can accept 401k loans, 403b loans. Those are allowed. You can access brokerage accounts. I would encourage clients to talk to their financial or tax advisor before accessing those assets because, those could create tax problems, potential loss of equity in the appreciation of those assets. So just check with your tax or financial advisor first. Gift funds can be also used, and that's where a family member is helping contribute towards your out-of-pocket expense. There is no seasoning requirement on gift funds, so a family member can jump in and help out right away. But most assets that are not gift funds will require a 60-day seasoning period. So when we think about home ownership and saving for it, it's going to come in two categories. It's going to be saving for down payment, but also for closing costs and prepaid items for your home purchase. So if I'm looking at buying a home for $300,000, I'm going to need a 3% down payment, which is $9,000, and probably another $6,000 to $9,000 for my closing costs. So probably saving $15,000 to $18,000, give or take. And for some of us attending classes, that might be a little difficult for us. And so we came up with this savings plan to kind of help encourage and provide more of a rhythm or discipline to saving for home ownership. So in this scenario, as you see on screen, let's say I'm paying $1,500 a month in rent, but my projected mortgage that I feel comfortable with is $3,000, right? Now, I know I'm still working on saving for that $3,000 mortgage amount, but if I can kind of switch things up on a monthly basis and start paying, because I have the cash flow to pay that mortgage payment today, I just lack the savings. So if on the first of the month when I'm paying my landlord $1,500, if I can create the discipline of now taking that additional $1,500 that I think I have in my budget capacity and now transfer that to my savings account, like I'm paying a $3,000 mortgage payment, it starts to grow over time, right? And by the end of 6 months, now I have what, $9,000 in my savings account. By the end of the year, I have 18,000, not including interest. So I think that can be a real simple but effective plan to help you achieve savings quicker. And like I said, it creates that discipline of, yeah, I'm used to paying that $3,000 a month. So when it comes to taking on that $3,000 mortgage payment, doesn't feel like a big lift. It's something I can do because I've been doing it from my savings plan that I had in place for the last 6 to 12 months. All right. So when we kind of save up for our home ownership, that's going to help us get closer to home ownership. But at the same time, there's also first-time homebuyer resources that are available to you in the state of Kansas, in the state of Missouri, and any other state that you're joining us from. There generally is housing finance agencies that focus on low to moderate income households that need support for home ownership. So the Kansas Housing Resources Corporation has a down payment assistance program of 15 to 20% in assistance of your sales price that can be used towards the down payment or closing costs. Essentially is a 0% interest loan and can be forgiven after 10 years. Of course, you have to keep occupancy in the home for those 10 years. And there are deed restrictions to that in terms of the use of property, but that can be a really super effective way of getting access to homeownership quicker. It's only available in certain areas of Kansas, so we can certainly talk offline on what areas would fit for you if you're deciding to purchase in those areas, but that's a great resource to help you on that path towards homeownership. We also have national programs too, like our Pathway DPA program. It's kind of a private label APM product. It's available on just the FHA loan, but allows up to 3.5% to 5% of the loan amount in assistance funds that can go towards your down payment and or closing costs for homeownership. So a lot of great tools to be able to access homeownership. And while that savings plan is great, and that'll help you as well to help augment what you need out of pocket for homeownership, I think assistance programs can be something to make homeownership more of a near-term goal instead of maybe a 2 to 3 year long-term goal. All right. All right, let's talk a little bit about the buying process and, where do I go from here? So after attending tonight's class, hopefully you found some encouragement around home ownership, feel like it's something that you can set as a financial goal for yourself, whether this year or next year. And we love to be a partner with you in setting those goals and designing a home buying plan for you. I meet one-on-one with clients to design those home buying consultation plans. They're about a 30-minute session. We do those all across the country. So whether you're buying in Kansas or Missouri or Texas or California, we can help kind of guide you in home ownership. And so that is kind of where I would recommend going from here after tonight's class. Now, from that consultation and having a design for your home buying plan, the output of that consultation is to have what we call as a pre-approval. And that pre-approval allows you to start your home shopping, which is the fun part of this journey, right? But the pre-approval essentially creates a baseline of numbers for you so you know exactly what your budget looks like, what your down payment's going to be. Maybe you're participating in some of the first-time buyer programs, and allows you to confidently go out in the market and start seeking out homes that fit your criteria of community, lifestyle, and ultimately overall budget. So that's step 2 in the process. So step 1's pre-approval. Step 2 is house hunting. We encourage you in the house hunting phase when it goes from online to in-person. Connect with your local realtor that's an expert in your community. They should also be experts in negotiations, have a really good sphere of influence that can get connected with local inspector companies that can help, figure out, is this the right home for you? But we have a preferred realtor network that we can introduce you to as well. But ultimately, we'd encourage you to work with a trusted realtor on that journey during step 2. And we'll work in partnership with that realtor because we're on the finance side. They're, of course, on the home shopping side and negotiation side, but that'll kind of work lock and step with the financing. Now, as you go out and seek different homes and maybe find a home that you love, you'll present an offer to that seller, and that offer presentation will come with the pre-approval that we've provided to you. If that offer is successfully negotiated and now you have an accepted offer with the seller, then we move to step 3. And at step 3, we now have entered escrow, and you have that agreement with you and the seller. And that kind of starts the processing really of the loan. Within 24 hours of that acceptance, you're going to get a call from me saying, congratulations, super excited about your house that you're going to be purchasing, and let you know a little bit about next steps and some of the actionable items on your side. We're also going to set you up for your follow-up video consultation now to go through all the design work of your financing, talk a little bit about market conditions of interest rates, what your expected out-of-pocket looks like, what program is going to be the right match again, just to kind of reaffirm conversations we had from your pre-approval, and then kind of give you an outline of what to expect ahead. Now, you do have some actionable items as a buyer, like making your deposit on your house, which essentially provides kind of a, investment into the transaction and tells the seller that, you're serious about moving forward in this transaction. The earnest money deposit will vary depending on what part of the country you're buying in, but ultimately it's usually about 1% to 2% of the overall sales price. Those funds will count towards your total out-of-pocket expense for your home purchase. Now, within most purchase contracts, there's a timeline of closing of when I'm going to essentially close escrow or a transfer of ownership. We call that the close of escrow date. That's usually 30 days. So from the date of accepted offer to when I get my keys, it takes about 30 days. It can be shorter depending on, how competitive you want to make in your offer. But inside of that 30 days, there's what we call as contingency timelines that essentially allow a buyer to do their investigative work on the house to make sure it's really a good fit for them. And that includes getting the house appraised, which as the lender will order that appraisal to make sure that the value is supporting what you're purchasing the home for. Your realtor will orchestrate inspections of the property. Could be a roof inspection, pool inspection, foundation, whatever they feel is needed based upon the condition of the property. And then finally, there'll be a loan contingency, which essentially is saying, let's get your loan approved. Let's make sure everything all kind of checks out. And then, you'll be able to have the kind of knowledge that, hey, my loan is all in place and everything is all good. Now, usually the contingency period is within the first 14 to 17 days of the contract period. And so you as a buyer can take the time to do your due diligence before you move forward in the transaction. Now, things behind the scenes are still moving along, like the processing of your financing, which includes income verification, verifying your assets, making sure the product type is all set up correctly, and ultimately submitting everything to an underwriting team who does all kind of the review process, verifying the program, making sure your assets support what your out-of-pocket looks like, all the important things from a risk standpoint that an underwriter does. Now, once that underwriting process is completed, that's going to probably take us about 2 to 2.5 weeks into the process of your home buying. And it also brings you more than likely to the end of your contingency period. So if you feel comfortable with your inspections you've gathered, your appraisal checks out with the sufficient value, and you have your loan approval, then you can essentially sign off on your contingencies. That tells the seller that you're okay moving to the final closing stages of the buying process. Now, as a lender, we need to provide to you a 3-day cooling off disclosure called a closing disclosure. Now, throughout the process, we provide a variety of different disclosures. There's initial disclosures within 72 hours of your accepted offer. There's revised disclosures that come out once we lock in your interest rate. And then you get final closing disclosures just about 3 days before your closing process. Now, once we get to the big day of closing, that's when we're signing final loan documents with a public notary. That's the one thing you do have to do in person other than, seeing your property in person, right? That takes about an hour or so. You go through all the legal documents for your financing. Once that process is completed, then you wire in final funds that's owed to buy your house. On the lending side, we complete one final audit and then wire in the funds for the home financing and any other assistance programs that you might elect as part of your home buying plan. Once those monies get received by the escrow or attorney team, then documents get recorded with the local county recorder's office. They usually record a grant deed that transfers ownership to you from seller to buyer, and then a deed for the actual loan that you're taking out to purchase your home, right? Now, once we get confirmation back that those things are recorded, then we get to celebrate with you because now you become the official owner of the home. And that's a big day. I got to make quite a few calls to clients in different markets across the country that are now getting the keys to their house today. It's probably one of my most enjoyable days because, we want to be there to celebrate with you. It's the biggest financial decision you're making, but when you get there, it's so rewarding. And so we want to be there as a partner during that journey, but also to celebrate when you guys get to the finish line. Now, we do have an aftercare program too, so our relationship doesn't stop after the closing process. We stay connected with our clients, whether that's updating them on interest rates for refinancing, getting them updated with our HomeBot system, which kind of shows them market activity for their home, and just providing them annual reviews of their mortgage to make sure they're always in the best possible position. Now, if you're thinking about moving forward on this home buying journey, we'd love to be a partner with you in that. Again, we provide discount services for our KU Alumni Association. These classes are something we can help support you with resources so you understand, what to expect in home ownership. And then from there, we want to meet with you for a consultation to design your own home buying plan. It is totally a free service we provide, whether you're going to buy this year in 2025 as a financial goal, or it's something you're thinking about 2 or 3 years from now. I just want to be able a chance to meet with you and impart some information on you to help you make a good financial decision. And so if you're thinking about doing that, we have a real simple get started process. It's an online application. It's the soft credit check that we talked about earlier. And then you upload some of the required documents. And then from there, you will go into our scheduling system and just schedule a 30-minute session with us. Again, it's a free service we provide to our alumni association. If you have questions after tonight's class and maybe didn't feel like you want to have them asked during the session, feel free to schedule an introductory call. That's where we get a chance to connect with you. And if you want to run some scenarios by us, we'd love to be able to kind of answer those questions for you. Here's what that consultation looks like. So if you're thinking about maybe it's something you may want to do, it's more about understanding your budget, where you want to buy, credit plans. Let's kind of review the savings plan based upon where your goals look like. And then kind of talk a little bit about what product might be the best match for you. And then the output of that, if you're ready to get pre-approved, would be that pre-approval to move you to step 2 in the buying process. I want to just quickly point out one of our resources for you on this journey, which is our mobile resources. You can start your application right from mobile. You can follow the progress of your loan. In fact, also do some really great calculations on different scenarios for you. So once you start kind of home shopping at step 2, you can use some of our mobile tools. Again, really super proud of our KU Alumni Association partnership. We do have your discount available to you when you decide to take those next steps of $750 in credit towards your closing costs. And you can always do refreshers of these classes. So we'll teach 2 more classes this year. And if you've enjoyed tonight's content, we'd encourage you to share this information with friends, family, maybe some colleagues at work that you think are considering homeownership and just want some tools and resources. We just want to be a trusted partner for anyone in our local communities in that journey. We also have other classes that are done through other alumni associations across the country. You can kind of see those listed here on this slide. And here's all my contact information. So if you do want to get connected with me just for a quick conversation, don't hesitate to shoot me an email, send me a text, call, whatever's good for you. And again, we've provided our scheduling link to schedule an upcoming consultation. And we also try to, on our social platforms, try to post a lot of great information for you as prospective homeowners. Not only is our YouTube channel going to house this class, but you jump over to our Instagram, you can see a lot of great information that's coming out daily to help you as a resource for you on your journey towards homeownership. With that said, I appreciate everybody joining tonight's class. Hopefully you found this useful. I'm going to open it up for some questions. I know I didn't really get any questions during tonight's class, but I want to we have a few minutes before we're at the top of the hour. And so I just want to make sure that I can answer any questions that our audience has. So if you do have questions, feel free to use the chat or the Q&A feature right now. I have both windows open. I'm more than happy to answer any questions that you have. And we may just be quiet with our questions tonight because we're all getting ready for March Madness, right? So everybody's saving all their energy for the big game. So, and it's okay if you don't have any questions. Again, I'd encourage you to get connected with me after tonight's class. We'd love to be able to kind of answer any questions that you have or need answering. So. All right. Well, again, we'll have all this content up on our YouTube channel tomorrow. We'll send out the presentation to you tomorrow. I appreciate everyone joining us on this Wednesday night. I wish everyone a great rest of your week. I look forward to connecting with each of you soon. Have a good night.